let's take a look at 3 stocks that might be worth you taking a further look into. These are stocks that many people would say are currently undervalued and are currently very cheap, and they have a lot of upside. But of course, as we move through this video, do let me know your opinions in the comments below. The first one up is PayPal. Now, PayPal is quite an interesting opportunity for me right now. The stock has been trading sideways for quite a while. Nothing's really been happening in terms of the stock price, but I would argue that fundamentally speaking, things have been happening. Things have been taking a turn. Now, at the current price, it is kind of priced as if there is going to be no expected future growth, which is a little bit odd as we're already seeing that happen. This idea that PayPal is soon going to be taken over by competitors is a common worry and, in my opinion, quite a misconception. I think a lot of people are thinking that PayPal is very old school, it's not innovative, it's not new, and it's quickly going to die like the dinosaurs. And when I'm speaking about competitors, I'm speaking about the likes of Apple Pay or Stripe, and there's this whole narrative that these competitors are going to quickly take market share away from PayPal. But actually, if you forget what the narrative is and you actually look at the data is showing us that this is not the case. And actually, PayPal still holds the majority of the market share. Currently, it holds about 45% of the global payments market share, and it also is the #1 payments processor globally. Now, looking away from what we're seeing maybe just in the stock price and actually thinking about what the company behind that stock price is doing, PayPal are actually managing to continue to grow and generate revenue. They're also decreasing their shares outstanding and increasing their cash piles. So all of these things are looking pretty positive. On top of this, their active customer accounts are growing and their total payment volumes have also been increasing. With all this said, right now, in my opinion, PayPal is undervalued and priced as if it will experience no growth, which, like I said, is just not the case. You may have noticed that recently the stock price has had a little boost, and this is because they reported their Q2 earnings and they were pretty well received. They did quite well. They raised their guidance for 2024, and we all know how important guidance has been in this earnings season and the previous earnings seasons, and they've also increased their share repurchasing plans. They increased cash flow and they are continuing to focus on growth and profitability. These are things that shareholders and potential future shareholders should care a lot about. And we know that there's been lots of changes at PayPal in terms of their leadership team, their CEO, the things that they are focusing on, new innovative projects that they are starting. And I do think they are still one to watch in the future. I don't believe that they're a dying company. I don't hold a lot of PayPal. I have it in my experiment account, but I am seeing it as a potential undervalued opportunity. Do let me know what you think in the comments below. Next up is a massive mega cap company, Microsoft. Microsoft stock is down by 12.63% in the last month. They also reported their Q2 earnings recently as well, and they were good. They beat both top line and bottom line, yet the shares fell about 7% post-earnings. And that just goes to show us that we can never really predict what's going to happen after an earnings. Sometimes we see a company come out and report a very strong earnings, the stock goes down. Other times companies come out and they report quite a weak earnings and the stock goes up. So there really is no predicting it. And it goes to show us as well that, trading and buying and selling around earnings can be pretty risky. It can increase the volatility. And I think the reason that the stock price fell after earnings is just because their cloud computing services came in slightly short than what people were expecting. But overall, we saw a very strong picture. We saw that revenue was up 15% year over year, operating income up 15% year over year as well, net income up 10%, and EPS up 10% too. So in my opinion, the sell-off was just simply not warranted. And we've seen this a few times in other companies that have recently reported their Q2 earnings as well. Financially speaking, Microsoft remain to appear very strong, and they are showing growth in various different business segments that they have. They are diversified in terms of where they're getting their revenue from. And I would say all the key metrics did look very good. I wouldn't say that Microsoft is the most undervalued company out there right now. I wouldn't say it's the biggest deal, the biggest opportunity in the market. There are definitely other companies that have been hit harder, that have sold off more and are less warranted in the sell-off than maybe Microsoft are right now. There are other deals. And if you look at some of the key metrics like price to earnings and all of that stuff, you would actually find that right now Microsoft is trading higher than its 5-year historical averages. But of course, these ratios, these PE ratios and all stuff like that, they're not the only things to look at. And for a big mega cap company like Microsoft, they have seen quite a substantial fall in stock price. So if you're someone that has been waiting to add a high quality tech company, you like the look of Microsoft, you've done your research, this could be a good opportunity at current prices. Microsoft right now, like many tech companies out there, are heavily investing into their cloud and AI infrastructure, including new data centers across various global locations. Now, these investments are obviously viewed as long-term assets, and it can actually take up to 15 years before you actually realize, before you actually see the returns on these investments. So people are seeing that, margins are decreasing right now because of their capex spending, because they're investing so much right now in the short term for profits, for revenue in the long term. But some people don't like that, and they're thinking that Microsoft aren't doing very, very well fundamentally. I would argue that short-term pain for long-term gain is important, but it's something to keep an eye on. Next up is SoFi. Now, SoFi stock has actually been showing some strength, and over the last 1 month, it's up by 2.78%, but year to date, it's still down by 31%, and over a 1-year period, 30%, 5-year period, 36%. They have recently exceeded their earnings expectations, including new member additions and increases in revenue, and now, of course, they have 3 quarters of GAAP profitability. The members growth chart is absolutely incredible. It's literally perfectly been increasing for each and every consecutive quarter. Obviously, at some point, this will plateau and slow down, but right now, this is an amazing thing to see. Now, not only are they adding more customers, they're bringing new customers into their business, into their ecosystem, you could say, but they're also keeping their existing customers very satisfied. As we can see that their existing customers are spending more and more money to buy more of their products, and that's obviously going to lead to scaling and profitability. In my opinion, we're still in very, very early days for SoFi. They are still a pretty small company, and they're up against some very, very big competitors. In the fintech space, when we're looking at stocks, we hear about SoFi all the time. And they have got very bullish metrics, and we're seeing a lot of good come out of them. However, in the real world, they are still a relatively small name. If you ask people in the US if they use SoFi, a lot of them currently don't. However, the younger generation are looking at alternative methods, and SoFi is a good option for them. But I see a lot of potential in SoFi because I really like seeing disruptive, innovative companies. I like seeing companies that come along and they shake up the way that a sector has been for a very long time. And with SoFi, they are, of course, disrupting the banking industry, and they are offering an all-in-one digital financial platform. And I think a lot of people in this day and age really want and really like that. The management team have raised guidance for Q3 and also for the full fiscal year of 2024, and this is really bullish for us to see. It's indicating that they are expecting strong growth momentum to continue. However, it is of course important to talk about the cons as well as the pros. Now, their technology platform, which is called Galileo, did show a slight miss in revenue estimates, and we saw that SoFi lowered the revenue growth expectations going forward from 20% to the mid to high teens. This does indicate a slight shift towards them being more reliant on the lending sector. However, I believe that this technology platform, Galileo, this segment is still very, very profitable, and I think it will do really, really well long term. I'm someone that has been considering adding SoFi and or new holdings to my portfolio for quite a while now. However, I have not yet decided to add either of these, and that is because every time I sit down and I think about it again, I'm thinking that I would rather put my money into an existing position that I have, but that's not to say that I don't think there is really good opportunity there. And I might change my mind soon and actually add these to my own portfolio. But do let me know your thoughts on all of these 3 stocks in the comments below. Let me know if you have been loading up on any of these recently. And until next time, keep investing, keep analyzing, and don't forget to hit that subscribe button.